everyone, my name is Amelia Lee Cheng Ru, matrix number 261480. Now I would like to present about case 5. In this case, Gera International held 75% ownership on Caribbean Brewers, which is located in Antigua, while the remaining 25% of the common shares of Caribbean Brewers were held by the senior manager and other employees. Moreover, it also wholly owned Gera Caribbean, which is located in Bermuda, a tax-free jurisdiction. Since Gera International became the majority shareholder of Caribbean Brewers, then there are many issues arose, such as cost allocation, transfer pricing, no bonus, low production efficiency, and so on. So, me as the new responsible and professional advisor to the CFO would like to understand the issues arose. Let's start with the first question. Cost allocations is a process of identifying, aggregating, and assigning costs to cost objects. It can be used in determining the profitability for subsidiary and derivation of transfer price between subsidiaries. Transfer pricing is the transaction price of goods and services for the related parties. It is usually lower or same as the market prices. Majority shareholder has the right to make decision in a corporation because it has control over the corporation. In this case, the majority shareholder is Gera International because it owns 75% of the Caribbean Brewer. Thus, Gera International can sweep wealth through accounting cost allocations and transfer pricing. It can purposely allocate higher costs in high tax area because it will bring down the net profit and reduce the taxable income. Moreover, it can manipulate higher profits of goods and services in a company that have lower tax rate by setting lower price for the transactions of selling beers to the companies that have lower price in order to show more profits. This manipulation may be beneficial to the major shareholders because they can receive dividends. Next, let's proceed to the second question. From the case, Tigua beer consumed longer and more time-intensive production process in the first two steps in the production, which are mulling and mash run. So it is not fair if the overhead costs allocated based on volume. The overhead cost should be allocated more to Tigua beer. Thus, this can be clearly seen that this cost allocation may increase the production cost of Gera beer and decrease its net profit, which lead to lower tax paid. Moreover, from figure 2, the variable cost of bottles has increased significantly from 0.7% in both 2007 and 2008 to 9.7% in year 2012. This is because the deposit of $8 per case of 24 is counted as the cost of production and is collected for all returnable markets, which include all domestic markets and export of Tigua beer. On the other hand, there was no deposit collected on the export market for Gera beer, so the cost of bottle is counted as expenses. Thus, this method of cost allocation reduces the production efficiencies. Next, from transfer pricing, Gera International, the majority shareholder, said all the export sales of Gera beer are produced to Gera Caribbean, which is a wholly owned subsidiary of Gera International and located in Bermuda, where there is a tax-free jurisdiction. In figure 1, we can see that the export of Gera beer surged in year 2010. This indicates that Gera International intentionally to obtain benefits of Gera Caribbean. In addition, the exported Gera beer is invoiced to Gera Caribbean at a lower price of $25 per case compared to domestic markets and export of Tigua beer of $50. Furthermore, the exports are shipped directly to the island, but the invoices are sent to Gera Caribbean first. Then Gera Caribbean will send the invoices to the other island in the Eastern Caribbean for $50 per case and deposit for bottles of $8 per case. So Gera Caribbean can earn more profit which is not taxable. From the above evidence, we can see that Gera International took granted and escaped from tax on its subsidiary. This causes the sales for Gera beer to decrease due to the lower price of $25 per case for exported Tigua beer. Net profit reduced and affected the reportable taxable income to be lower. Thus, lower tax is paid. Next, let's proceed to the third question. Firstly, the wealth shifting harmed the minority shareholders. In this case, the remaining of 25% common shares of Caribbean Brewer was held by the senior management and other employees. They are negatively affected. Jason Joseph, the production manager, previously owned 25% of Caribbean Brewers but now had decreased to 8%. Since Gera Caribbean became the majority shareholder of Caribbean Brewers, there have been no dividends. When transfer pricing occurs, it will lower the net profit of the company and lead to a lower of dividends payment to the shareholders. So, the minority shareholders could not receive dividends. Secondly, the wealth shifting has harmed the employees. Through cost allocation, the production efficiencies decline. As we can see that JJ and other production personnel are eligible to receive bonus if the total production costs less than 43% of sales. So the cost allocation done may increase the total production cost and cause them to be suffer from the bonus. Moreover, transfer pricing may reduce the net profit of the company. So when the company assesses the employees' performance from the net profit of the company, then their bonus will be affected. Transfer pricing also causes the company encounter losses in their wealth and reduce the payment of bonus to the employees. Thirdly, the wealth shifting also harmed the government of Antigua. Gera International has intention to reduce the tax payment through cost allocation and transfer pricing. This causes the government to reduce their revenue received and thus they have insufficient funds to build and maintain the infrastructures in Antigua. This has reduced the benefits received by the citizens. Next, let's continue with the fourth question. Firstly, as an advisor, I am responsible to the CFO of Caribbean Brewers. CFO is the senior executive who has responsibilities in managing the financial actions of a company. So I need to advise the CFO on cash flow, financial planning, and analysis of the Caribbean Brewers' financial strengths and weaknesses. Moreover, I can provide guidance in managing financial forecasting and budgets based on the financial reporting. Secondly, as an advisor to the CFO, I am responsible to the head of accountant. I can provide assistance in preparing the profitability statements. Thirdly, as an advisor, I am responsible to the production manager, Jason Joseph. I can provide advice on the ambiguities of JJ, such as the efficiencies in production, the quality of beer, and so on. Fourthly, as an advisor to CFO, I am responsible to CEO and Board of Directors of Caribbean Brewers. This is because CFO needs to report to CEO about the financial matters in the company, while both CFO and CEO are responsible to the Board of Directors. So indirectly, I need to provide my professional point of view regarding to the financial perspective to CEO and BOD. Fifthly, as an advisor to CFO, I am responsible to the Code of Ethics of MIA. I should always follow the Code of Ethics such as professional behavior, integrity, confidentiality, competence and due care, and objectivity. Sixthly, as an advisor, I am responsible to the code of ethics in my religious belief. Next, let's proceed to the fifth question. In this case, the minority shareholders may get impacted. This is because the decisions of the company are made by the majority shareholder and they might not consider the perspective of the minority shareholders. In this case, the implications of the composition of board members to the reporting of CFO is mainly concerned on GERA International as a whole. They will pressurize on the CFO to make sure that GERA International earns profits and pay lesser tax. In conclusion, transfer pricing itself is legal, but what is illegal is transfer mispricing, which is the transfer pricing manipulation. Moreover, if a company uses transfer pricing at a fair market value to simply pay lower taxes in another country, it is not violating any ethical standards. However, if the company intentionally lower the selling price of their goods to reduce their tax bill, then they are guilty of tax evasion. That's all from me. Thank you.